Do you know that alongside large public funding, there are substantial flows of private capital directed toward climate projects? We often think that only governments or international institutions can support initiatives to reduce emissions and protect ecosystems, but in reality, private money plays a fundamental role. Imagine an ecosystem where investment funds, family offices, and even individual investors channel money into green solutions, from reforestation to carbon capture technologies, from startups developing sustainable materials to established companies adopting low-impact practices. This private capital can accelerate positive climate change and at the same time offer return opportunities. When I began exploring this topic, I was struck by how private finance is organizing itself. There are specific vehicles dedicated to climate investments, such as green private equity, venture capital funds focused on clean tech, and sustainable infrastructure. These instruments gather resources from investors who believe not only in profit potential, but also in environmental impact. The motivation is not just ethical. It is increasingly clear that resilient and innovative companies in the green sector can generate long-term value, reducing risks linked to regulatory shifts or unfavorable climate conditions. Thus, investing in the climate becomes at once a financial strategy and a concrete contribution to the planet. Often, private climate funds work in collaboration with public entities or NGOs. Through public-private partnerships, synergies form that improve project feasibility. For example, a local government may offer incentives or guarantees, while a private fund provides capital and managerial expertise. In other cases, private investors support startups developing renewable energy technologies or energy efficiency solutions for existing buildings. I have tracked cases where a small group of investors enabled a solar microgrid project in remote communities to move past the pilot phase, demonstrating that the private sector can fill gaps that otherwise would remain unaddressed. Another surprising aspect concerns green corporate bonds issued by large companies. Various issuers attract private capital by selling bonds earmarked for climate purposes. Buyers of these bonds help finance a company's decarbonization plans or energy transition projects. These instruments are often accompanied by monitoring reports showing how the funds are used. This approach offers transparency that allows the investor to follow the environmental impact in concrete terms. In my own experience, I appreciated the difference between an investment that merely claims to be green and one that documents results step by step. Private capital always seeks real evidence, not slogans. Moreover, private capital includes direct investments by major family offices and high-net-worth investors who dedicate portions of their portfolios to climate initiatives. Often, these are long-term projects, where a long-horizon vision aligns with the goal of leaving a positive legacy. These investors favor initiatives combining environmental benefits with sustainable growth potential. In conversations with professionals in the sector, I discovered that some have created foundations or dedicated vehicles for startups working on clean technologies, believing that the true return can be measured not only in financial terms, but also in climate benefits. Finally, there are crowdfunding and collective investment platforms that involve smaller investors interested in climate projects. This democratization of capital means that anyone with accessible amounts can participate in reforestation projects, energy efficiency upgrades, or renewable installations. I have observed how these initiatives create a community of supporters who not only finance but become ambassadors for the project, sharing results and spreading awareness. It is a powerful mechanism. Private capital becomes active participation, not just financial contribution. Now let's dive into how to evaluate climate financing opportunities with private capital in a conscious and rigorous way, without losing sight of real impact and sustainable returns. When exploring a project that requires private resources for the climate, it is essential to apply clear criteria and reflect on concrete parameters, so as to distinguish serious initiatives from less transparent proposals. First, we need to focus on environmental impact objectives. Every project must precisely define the results it intends to achieve. For example, reducing greenhouse gas emissions by a certain amount, increasing carbon absorption capacity through reforestation, improving energy efficiency in existing buildings, or developing capture and storage technologies. It is useful to ask whether there is a measurable, verifiable indicator, using methods shared and recognized at the international level. When I examined investment proposals, I always looked for indicators tied to known standards, so I could compare multiple opportunities using the same yardstick. A second criterion concerns the credibility of those managing the project. It is important to assess the skills and experience of the promoting team. People or organizations that have already led similar successful initiatives or that have a solid scientific and technical background. Often it is useful to seek independent opinions, read analyses by experts, or reviews from professionals in the climate and sustainability field. This way, one evaluates the ability to carry out the project within the planned timeframe, handle unexpected issues, and honor commitments. A transparent promoter with regular reports and openness to dialogue inspires greater trust than someone who provides only vague announcements. The third aspect is the financial structure and the proportion of private capital required relative to other sources. When a climate project is presented, it often integrates public contributions, grants, or incentives alongside private capital. It is important to understand how these sources combine. A project that anticipates public co-financing or state guarantees can reduce the risk for the private investor. Conversely, initiatives relying exclusively on private funds may offer higher return potential, but with a correspondingly higher risk. I learned to read financial documents explaining the business model, cost structure, and revenue streams in order to assess whether economic sustainability supports environmental sustainability. The fourth criterion is timing and progress monitoring. Every climate initiative must indicate clear intermediate milestones, design phases, project startup, completion of installations, or on-the-ground actions. A well-defined plan shows deadlines and milestones with verification measures. During evaluation, I asked, are there periodic reports describing advances and critical issues? Who oversees adherence to the initial plan? It is useful if there are reviewers or third-party entities tasked with validating results. This approach prevents funds from being stuck or diverted to other uses. The fifth point is analyzing expected returns. While keeping in mind that environmental motivation is central, it is necessary to know what financial return is realistic. Often yields offered by climate projects can be lower than in more speculative opportunities, but they are offset by advantages such as tax incentives or lower correlation with volatile markets. One must estimate the real net return, considering management costs, possible intermediary fees, and the impact of potential delays. In my experience, I compared cash flow estimates under pessimistic and optimistic scenarios to understand the range of possible variations and choose an exposure level appropriate to my risk tolerance. The sixth element is transparency and preventing greenwashing. A serious project displays operational details and accessible documentation. I learned to favor initiatives that publish open data, perhaps on platforms allowing real-time or quarterly tracking of progress. When information is sparse or vague, one must raise the alert level. It is possible to request official documents, contact project contacts, consult institutional websites or reports from independent agencies. Clarity on measurement methodologies, certifications obtained, and standards applied is an indicator of seriousness. The seventh aspect is collaborative dimension and participation of local stakeholders. Climate projects often impact communities and territories. A responsible investment evaluates how benefits are shared with those living in the affected areas. Employment, access to clean technologies, ecosystem protection, involvement of local populations. I learned a lot by observing cases where the community is an active participant. partially funding, joining governance, or receiving direct services. This approach reduces social risks and strengthens positive impact. The eighth criterion is integrating financial metrics and impact metrics into a unified evaluation system. This involves defining indicators reflecting both economic value and environmental benefit. For example, measuring cost per ton of avoided CO2 or estimating value created in terms of total energy savings. A combined evaluation helps compare multiple projects and select those offering the best balance between impact and return. I used comparison sheets where each project received a score on various parameters, facilitating objective decisions. The ninth element is continuity of support and exit possibilities. It is useful to know if there are paths to exit or reduce exposure in case of scenario changes or personal needs. Some initiatives provide secondary markets or financial instruments allowing one to sell shares before maturity. In other cases, one can reinvest in new projects, ensuring continuity of climate commitment. I considered this flexibility as a safety factor because it offers alternatives even in situations of need. The 10th point is alignment with global objectives and emerging regulations. Evaluate whether a project is consistent with internationally recognized sustainable development goals, such as emission reduction by set deadlines or contribution to national energy transitions. Projects aligned with official climate policies tend to receive additional support and reduce regulatory uncertainty. I relied on official documents from international agencies to verify this coherence. Finally, it is useful to leverage digital tools and analysis platforms for climate investments. There are applications that aggregate data on projects, sustainability ratings, and environmental performance indicators. Although they cannot replace personal evaluation, they offer a quick overview to identify opportunities worth deeper investigation. I experimented with dashboards showing comparisons between investments based on impact and return criteria, simplifying pre-selection. With these criteria and tools, you can build a robust selection process, define impact objectives, verify credibility of promoters, analyze financial structure, examine timing and returns, monitor transparency, consider stakeholders, integrate metrics, evaluate exit options and regulatory alignment, and use analysis platforms. In this way, investing private capital in climate projects becomes a structured journey based on thorough information and critical thinking. With this reflection, you have a method to choose private climate projects with greater awareness. As you continue exploring, you can further refine your approach by learning from results and updating criteria according to sector evolution. This way of proceeding makes the investment experience not only financial, but also educational and meaningful. In every decision lies the opportunity to combine return and positive impact, creating value for you and for the planet. Here is the final Part 3 script in English for the episode, Who's Financing Climate Via Private Money?, written in a natural, engaging, and professional style optimized for HeyGen, designed to complete a video of at least 15 minutes total. Imagine your portfolio as a garden to be tended. Some plants grow quickly and others require time, but all need care and attention. Incorporating climate investments into a well-constructed portfolio does not mean giving up returns, but rather redefining the word return to include environmental, social, and ethical impact. It is a transformation that starts with a simple question: what sense does it make to grow capital if in the meantime we worsen the world we live in? One of the first strategic choices is defining what percentage of capital to allocate to private climate projects. There is no one-size-fits-all formula. For some, it may be a small portion of the portfolio. For others, a central component. What matters is finding balance between time horizon, risk tolerance, and personal values. If you have a long-term vision, you might choose infrastructure projects with slower but stable returns. If you prefer greater liquidity, you can turn to dynamic instruments like thematic funds or equity crowdfunding platforms. It is also useful to diversify by project type and geography. For example, you can support initiatives in emerging countries where impact can be enormous but risks higher, and local projects with greater traceability. I myself chose a combination, part in a European fund dedicated to urban energy efficiency, and part in an African reforestation project with social benefits included. This approach allowed me to balance return, impact, and security. Another element not to overlook is personal engagement and information gathering. When you invest in climate projects, do not do so passively. Subscribe to promoters' newsletters, read progress reports, attend webinars or meetings. The more involved you are, the more your investment becomes an active choice, a path of continuous learning. I discovered that closely following projects not only increases satisfaction, but also helps prevent disappointments, because you can spot weak signals before they develop into problems. Over time, you might decide to increase your exposure to climate investments as you gain confidence. Some investors start with small amounts and then, seeing results and gaining awareness, expand their commitment. This is a natural process to be undertaken without rush, with curiosity and critical spirit. Even small, consistent steps can generate real change. One aspect that deeply struck me is the connection between finance and community. In many private climate projects, especially at local scale, there is an opportunity to build relationships, getting to know beneficiaries, understanding local dynamics, seeing concrete effects. This brings the investment closer to real life and makes it tangible. I remember the moment I saw the first images of solar panels installed thanks to a project I supported. It was exciting. It was no longer just a chart on a platform. It was real energy produced by real families. Of course, even when emotions are involved, we must not lose financial clarity. Every 6 to 12 months, take a moment to review your strategy. Assess whether projects are progressing as planned, whether your personal goals have changed, whether new opportunities have emerged. This allows you to adapt to context, without chasing every novelty, but also not remaining static while everything around evolves. Throughout this, do not forget the power of the multiplier effect. Talking with friends, family, or colleagues about your climate investments can inspire others to do the same. Private capital can become a collective movement. The more people understand the potential of climate finance, the faster change becomes real. That is why I often share my experience, not to boast, but to show that it is possible, accessible, and concrete. Capital is not just a means to get rich. It is a tool to leave a positive mark on the world. If all this still seems distant or complicated, start with a question. What do I want my money to do while I am not using it? If the answer is protect the future, support change, create lasting value, then you have already chosen the right direction. Thank you for listening up to here. If you want to delve deeper into other aspects of sustainable finance, discover innovative tools, and understand how to navigate among today's countless possibilities, subscribe to the channel and activate the notification bell. Every week I will share new content, concrete examples, and simple strategies to make your capital work in an intelligent, responsible, and inspiring way. See you in the next video.